the Genius Multi channel. Silver up to 1767, getting real close to that $18 mark. Gold up 1295.20, up 1250 this morning, almost closing in on 1300. Gold surging to 7-week high on weaker dollar and political risk. It's a story coming out of Reuters. Gold rose to its highest level in 7 weeks on Tuesday as weak economic data in the United States reduced expectations of rapid U.S. interest rate rises this year, pushing the dollar to a 7-month low and lowering U.S. bond yields. Investors were also drawn to gold, seen as a safe place to park assets by uncertainty around Thursday's European Central Bank meeting, an election in Britain, and testimony to a Senate committee by former FBI Director James Comey. And here's a quick peek at the gold chart from this morning. There it is at 1295.30, up 1260, or close to 1% for the morning. Here you see oil up, gold up, and then both the euro and dollar down. So with the dollar down, of course, gold's going to rise, but also with the euro and the dollar both dropping, you'll see commodity prices do pretty well. Taking a look at a 5-day chart for the dollar, you can see it just plummet off of that 97.3 mark. They're already hitting, I thought I saw it at 94 at some point. I might be wrong, maybe it was 95. But the dollar's, it's dropping, it's going lower, and that's definitely having an effect on both precious metals and oil. And here we see global markets. Jitters push treasury yields, dollar to 7-month lows. This is by Hillary Russ from New York. U.S. Treasury yields and the dollar dropped to 7-month lows on Tuesday, and world stocks slid as political uncertainty from the United States to the Middle East and weakness in commodity markets pushed investors away from risky assets. The yen and gold also gained amid prevailing caution as an Arab rift opened up around Qatar and ahead of testimony from the former head of the FBI, the British election, and the European Central Bank's next move, which all happened on Thursday. Amidst these headlines, we see China's gold imports seen jumping 50% as haven demand booms. This is out today from Ranjitha Pakyam. Bloomberg, China, the world's biggest gold market, may boost imports through Hong Kong by about half this year as local investors seek to protect their wealth from currency risks, a slowing property market, and volatile stocks, according to the Chinese Gold and Silver Exchange Society. Mainland China is set to import about 1,000 metric tons from the territory in 2017, said Haywood Chung, president of the century-old exchange in Hong Kong, which trades physical gold and silver. That compares with net purchases of 647 tons last year and would be the biggest since 2013, data from the Hong Kong Census and Statistics Department compiled by Bloomberg show. Taking a look at the chart, stocking up, China's gold imports heading higher in 2017. There you can see the kilos. They're on the right side, and then the years are down on the bottom there. Definitely spiking up the net imports from Hong Kong as China stocks up on more gold. Demand is rising on concerns over property, share and bond markets, and the outlook for the yuan, amid a government drive to reduce leverage in the financial system. Local consumption was up 15% in the first quarter, with sales of bars for investment climbing more than 60% and dwarfing a 1.4% rise in jewelry buying, according to the data from the China Gold Association. China also imports gold from Switzerland. Quote, people are looking at other means to invest, a safe haven to protect their renminbi because of the depreciation. So everybody starts to look for safe haven products, unquote, Chung said in an interview at a precious metals conference in Singapore on Monday. Quote, so I think we're going to have a good year, unquote. Imports from Switzerland topped 100 tons in the first 4 months of the year, according to calculations on data reported by the Swiss Federal Customs Administration. In December, China imported 158 tons from the country, taking the total for the year to 442 tons, up from 288 tons in 2015, the data shows. Investment demand. Global investors have also increased holdings. Assets in the SPDR Gold Trust, the world's largest exchange-traded fund, backed by bullion, have climbed by more than 6% since the end of January to 851 tons as of June 5th. Bullion rose as much as 1.1% to $1,293.78 an ounce on Tuesday, the highest level in about 7 weeks, and traded at $1,292.10 by 1:50 p.m. in London. The Chinese Gold and Silver Exchange Society is planning to build a bonded warehouse in Quanhai with a storage capacity of 1,500 tons of gold, and completion is expected in 2 to 3 years, said Chung, who has 33 years of experience in the industry. A temporary warehouse, which holds about 50 to 100 tons of gold, will be operational by the end of this year, he said. Well, not only are the Chinese stacking, but India as well, as we should expect. Here's Money News yesterday. India's May gold imports surge fourfold from a year ago. It's from the GFMS. India's gold imports in May surged fourfold from a year ago to 103 tons as jewelers increased purchases to replenish inventory and stock up ahead of the rollout of the Goods and Services Tax. Provisional data from consultancy GFMS showed. The rise in imports by the world's second biggest consumer of the precious metal will likely support global prices that are near their highest in 6 weeks, but could widen the South Asian country's trade deficit. I found this recent PDF from ICBC Standard Bank. This is from June 2nd, 2017. Gold hits a rates home run. And there's some interesting information as well buried in this material, so let's go through it quickly. Gold hits a rates home run. Look at the yield curve, not the jobs data. Today's below par economic data triggered a drop in treasury yields and a near $15 jump in gold. Contrary to most headlines, it was not the payrolls figures that pushed gold up, but weak inflation data. The fact that news wires are still issuing reports directly linking gold to the monthly U.S. jobs numbers almost a decade after the beginnings of the global financial crisis shows just how unusual and prolonged this period of global economic malaise has become. Perhaps the malaise is not in the global economy, but in investors' expectations. Valuation models that worked when global GDP was running at 3% and developed market real interest rates were typically up to plus 2% are probably less useful when 2% is an ambition for global GDP and real rates have settled around 0% at best. Many market participants still find it hard to break the habits of a lifetime and reconcile their investment thesis to what should now be just called normal, no longer new normal. Where does gold fit in the new investment matrix? Judging by some of the recent, often contradictory commentary, it is resuming its status, last seen just before it collapsed in 2013, as a Johann's factotum of portfolios, the diversifier and risk absorber for every eventuality. Scared by inflation? Buy gold. Scared of debasement of fiat currencies by profligate central bankers? Buy gold. Scared by equity and or real estate valuations? Buy gold. Scared by Kim Jong-un? Buy gold. Scared by $20 trillion in U.S. public debt? Buy gold. Scared by a lack of liquidity in fixed income markets? Buy gold. Scared by Chinese off-balance sheet liabilities? Buy gold. And so it goes on. We'll take a look at the yield chart here. The German 10-year, Japan 10-year, and the Swiss 10-year. Lower U.S. yields tend to feed into downward pressure on the dollar. The index looks to be headed back upwards, the 95 level, as euro in particular continues to strengthen, up 7.3% year to date. Even if the FOMC does vote for a rate increase of 25 basis points, precedent suggests that will be felt at the front of the rates curve but will have little impact further out. And gold has tended to react more to moves in rates in the 2 to 5 year bucket. In fact, the 3-month T-bill has more or less fully priced in a 25 basis points hike, whereas 2-year Treasury yields have been flat and yields on 5 and 10-year Treasuries have been sinking. The yield curve is undergoing one of its periodic collapses. Here's the U.S. yield curve collapse again. There you see it from January 12, 13, 14, dropping down in 15, dropping again 2016, and then inched upward, and then now it is downward once more in 2017. To be clear, at this time we are not bearish on gold. Last week we suggested gold had a good chance to trade above $1,300 by July 4th, U.S. Independence Day, and we have been a bit conservative on that. Today's price action is encouraging from a technical perspective, and a successful break of 1,300 could see an overshoot towards $1,340. But investors are not best served by spurious reasons as to why that might occur. And in closing, in today's brief look at the news and a shorter news video compared to some of the ones we've done in the past, we'll take a look at the 24-hour spot silver. Silver is up, and as we said earlier, we're getting real close to that $18 mark. I think it's going to get there at some point within the next week or so. And this came up during a conversation during one of the live broadcasts we had. Stackin' AG47 asked if we thought silver might reach the 18 mark this coming week, and it looks like he was onto something, and he had somewhat of an internal premonition on where silver might end up this week, and I hope he's right. I hope we can appease Stackin' AG and see it hit that 18. It would be exciting, although I do like buying it cheaper. So the longer it stays at these levels, we know ultimately it's going to rise away from these levels. However, the longer it's here, the more easy it is for us to exchange less fiat paper for more metal. And I always like being in that position rather than the opposite. A final chart until I get to the fun article I'm going to put together for the next video, which is more of a historical story. We'll take a look at this monthly NASDAQ 100 index and silver prices. So you can see them flip there and trade places over the course of time. You'll see where the NASDAQ in the black shot up right around that dot-com bubble, 1999, year 2000, with silver being well below. You can see it just sitting there flat from about 1988 all the way through to 2003, about where silver starts to uptick. But when you see the NASDAQ then collapse and silver catch up to it, you can see right around 2007, 8, they kind of switch places briefly, and then right around past 2009 to 10, silver shoots up during that financial crisis right afterwards, and during the course of things past the NASDAQ mark there. And then once again they've switched places right around 2012 with silver falling below, and now it's well below the $20 mark with the NASDAQ sitting up around 6,000. Well, if they switch places again, this is one of those charts that shows if you're heavily placed in the NASDAQ, this is a good time to exchange your NASDAQ 100 for silver. You do so in these switch places, you can reap some serious profits and multiply your holdings and your wealth. It's a good decision to make, and there's some people play that game. I don't do the whole jumping from one asset class to the other, and I'm just not into getting that rich, really. I just want to preserve what I have, keep what I've got, not lose it, and live a comfortable and happy life. Not spending too much time dwelling on moving wealth around and playing the game. I'm not into the casino thing. I'm not there. I'm not sitting down at their table. But for those that are interested, those that might wish to participate, here you go. There's a chart that you can look at and, well, use it for what it's worth. Thanks for being part here of the Junie Smallby channel. Always liking, sharing, subscribing, contributing, being part of the conversation. And have a good day, and see you on the next one.